Well, let's get some reaction now to the capital gains tax plan changes from Jack Mintz, President's Fellow at the School of Public Policy at the University of Calgary. Jack, what's been your assessment of the changes and the conversation that's been ensuing since the budget?
Well, first of all, on the political side, it does seem like there's a bit of a game going on between the Conservatives and the Liberals. The Conservatives did not react to the capital gains budget changes, and I think that was purposely done so they wouldn't be browbeat by the Prime Minister that they're trying to support the rich, although clearly that's not the case in the sense that there's going to be a lot of middle-income people that are going to be affected by the change. And perhaps the Liberals were trying to embarrass the Conservatives to vote against this particular provision so that they could then go on about, that they're supporting rich people. But I guess if it starts becoming more and more an issue, and I think it is becoming a bigger issue now, the capital gains tax increase, because it is hurting a lot of middle-income people, not just people that own cottages, but even people who have capital gains, and there are people that have. We have to remember they hold shares for a very long time, so it's very easy to get over $250,000 in 1 year when you finally dispose your shares. So it does hit a lot of middle-income people, and I think maybe the government is going to try to maybe fix some of that in the present, in the actual bill that's going to be presented, but we'll see.
Okay. If they're listening to you now, what would be your suggestion on where you could make some changes that might be beneficial to the economy? Because at the end of the day, I think a lot of the reaction has been about what this ultimately means for the growth of our economy if there's a focus on taxation as opposed to growing the overall economy.
Well, there's actually two things I would have done quite differently than what was in the budget. I think we have a very serious problem in having very high marginal tax rates. Some of them are actually at the $30,000 level because of income-tested benefits, but also at the top end. Canada, of the G7 countries, has the third highest marginal tax rate, personal income tax rate, which is over 50%, roughly about 53% across the country. And what that means is that people, if they work a little bit harder, they have the government taking more than half of the money away from them, which I think has really, spurred a lot of negative reaction, which leads to more tax avoidance and in some cases, even people leaving the country. So I think we need to address that issue. And I have always felt that one of the issues was that there is an argument for raising the capital gains inclusion rate because the capital gains tax rate is below the dividend tax rate. And there's always a policy going back to 1972 about keeping that relatively similar, so this way people wouldn't try to pass out income in the form of capital gains or dividends once you have a misalignment between those two rates. But I think that that issue, I think, suggests to me that if we did fix the capital gains tax rate by increasing the inclusion rate, then that should have gone into money to reduce the top marginal rates, because I think that's a serious issue. And we do need more productivity. It's a serious issue. We've had falling GDP per capita now in this country for now almost 2 years. It's going to be probably going to happen again in this year. And there needs to be a much bigger focus on trying to grow the economy. And I think this is where the capital gains increase, I think, is a very wrong signal. It's, again, more redistribution without actually trying to encourage more growth in the private sector.
Okay, now you did talk about tax avoidance. On the work you've done on that, how big of a risk is that, assuming we continue down this path and things proceed as planned on the changes?
Well, I think there's going to be a lot of things done to avoid some of that capital gains tax increase. One of the things that I think is very poorly designed is to have a $250,000 exemption if you hold your assets personally, as opposed to holding it within a corporation. That's going to encourage a lot of games playing. You're going to see people that will transfer assets out of their private corporation and hold it directly, because this way they can get their $250,000 exemption, because the corporate capital gains does not get that $250,000 exemption. So if you want to take advantage of it, move some of your assets into your personal hands rather than keeping it into the private corporation. But then there'll be other things. People can, sell, they can time their capital gains so they always stay under the $250,000 exemption limit. And of course, given it's not being implemented until June, and the government's going to have to introduce their legislation soon. But if it's going to be implemented in June, there's going to be a lot of people that will crystallize their capital gains right now in order to take advantage of the half inclusion rate, and then just hold their assets for a much longer period down the road. So there's going to be a lot of tax avoidance in that way. And I actually am not sure the government's going to pick up as much money as I think they're going to pick up as a result of this tax avoidance.
Well,